All right, we are going to begin chapter 18 today, and the focus of chapter 18 is on when businesses have to borrow money on a short-term basis in order to maintain their operations. It's not realistic to think that they can always just have cash in the bank. That would be nice, but sometimes it becomes necessary to get some credit, borrow some money in various ways. And so this first lesson, this section 18-1, is we're going to work through some journal entries that involve borrowing on a short-term basis in some different ways. So the best way to go about this, I think, is just to do those 4 journal entries that you see on page 557 under the Work Together problem. And I'll just do these with you. So on March the 3rd, our company, the Klein Company, drew $6,500 on its line of credit. And just real quickly, if you're not familiar with what a line of credit is, the bank will, for a fee, maybe it's like $25, $30 a year, it's not really a lot of money, but if you meet certain criteria, you got a good credit rating, you can basically just go to the bank without having to go through all the paperwork. They will have a certain amount of money there for you to borrow. So a line of credit, the advantage of it is, as opposed to a loan, you have to go through a lot of paperwork. You have to go through a lot of checking. They check your background. They check your credit. Well, with a line of credit, it's like this money is waiting for you whenever you need it. Okay, of course, there's going to be interest, but there's a convenience factor there that you just go to the bank and you say, I've got a line of credit of $20,000. I've got something that came up. It's an emergency. I need to get $10,000 of that. Sure, it's already set up. You take your $10,000, and then from that point on, interest will accrue. So at the point of drawing on that line of credit, basically you got to think of it this way. We just received, our company, Klein, received $6,500 in cash. So we're going to go to the cash receipts journal on that page. You see you have 3 different journals. All right, so on the cash receipts journal, we're going to assume, you see this little break, we've had other activity before this date. So we're just going to write the 3rd. This happened on March the 3rd. And we literally write, I'm going to try to squeeze it in, line of credit in the account title. The document number is given as R, which is a receipt 146. And I know I bled over into that column, but we're not going to be posting in this lesson, so we're not going to need that post-reference column anyway. So it's pretty easy. This is a liability. Do you remember how we increase liabilities, debit or credit? Credit. All right, so we're going to credit the line of credit, or $6,500. And then the debit is to cash because we received cash. And that takes care of the entry on March the 3rd. All right. Now, March 26th is, we talked about this a little bit a few chapters ago. When it becomes necessary, maybe we have an accounts payable. We owe someone money, and we need more time. Accounts payable is usually 30 to 60 days. We will pay it off. But if we see that we're going to need more time than that, we need to extend that maybe as much as a year, then that accounts payable needs to be converted to a note payable. Okay, so this entry, that's what this one's about. We're basically taking one liability, accounts payable, and we're converting it into a more of a long-term liability called notes payable. Okay, so they give us a lot of details there, but essentially we're going to go to the general journal, and once again we can assume there was other activity before this break, so we're just going to pick up with the 26th in the general journal. And it's pretty simply taking the accounts payable that was on the books as a credit, and we're going to take it off. So we're going to debit accounts payable slash MVT supply. Okay, so that takes that liability off the books, and now we're going to put this liability on notes payable. You see the document number there, it's M92, and the debit and the credit are the same, $2,400, the face value of the note. And that's how you journalize that transaction. Now, all the information regarding the 90 days and the 10%, that won't really be used until we actually pay it back. All right, so initially when you first sign the note, you just record the face value of the note. Okay, so now we're in June, and June the 24th, the first two words you see are paid cash, so we know we're going to go to the cash payments journal. Okay, so here we are paying that note that we signed on March the 26th. Okay, so this is a little bit of review. Let's figure out how much interest accrued over that time. All right, so let's see, we paid cash for the maturity value. So maturity value was $2,400. It was a 90-day note at 10% interest. And so remember, 90 over 360 is the fraction. And what does that come out to be using your calculator? $60, okay? So $60 is what we will pay them in interest money. All right, so let's put it all together in the journal entry. So once again, we're assuming activity above, so we can just put the day, it's the 24th. We're going to take this note off the books that we put on the books here on the 26th. We're going to debit notes payable because we're paying it off. And that's $2,400, the face. Okay, and then we said we have to pay them interest on this note, so next line, interest expense. Also a debit, $60. And then the total of those will be our credit to cash. So over here in the cash credit column, we're going to record $2,460. And that takes care of the 24th of June. Okay, any questions so far? All right, let's move to June the 30th. We see the first two words again, paid cash, so we're going to go back to the cash payments journal. We have the monthly payment on the line of credit, and that monthly payment we're told is $1,500 plus an interest charge of $64.20. All right, so here we are with the 30th. Originally, when we signed the line of credit, it was liability, so we credited it to increase that liability. Well, now we're paying it off, so we're going to debit line of credit. For $1,500. And we have that interest expense associated with this payment. And we were told that was $64.20, I believe, yep. And then the total of those will be the credit to cash, 1564.20. Okay, so those are the 4 types of entries that are discussed in section 18.1. Lines of credit, converting accounts payable to notes payable, paying off the notes payable with interest, paying off the line of credit with interest. So now we're going to work on the on your own 18.1 and the application 18.1 just to practice these entries.